for joining us on this webinar as we look at unlocking the value in private equity. My name is Kerry Craig. I'm a global market strategist here at JP Morgan, and I'm extremely pleased today to be joined by Ushmi Malhotra, who is our co-head of our private equity group based out of New York, but currently traveling in the region. So we're very blessed that she's joining us today within the same time zone to share her views around the private equity landscape and what we're seeing in terms of trend. So good morning, Ushmi.
Good morning. Thank you for having me.
Now, Ushmi, I have a whole range of questions that I've prepared for you, and I'm going to draw on some of our content from our guide to alternatives, looking at some of the trends we're seeing in the data, getting your views on whether that's still consistent with how things are moving, given the lags we do have in that data, and where we're seeing opportunities come through. Now, Ushmi, before I turn to you and get your views, I just want to take a minute or two just to set the scene a little bit and look at some of the data that we're seeing in our guide to alternatives, particularly around what we've experienced in public markets just over the last few weeks since the start of August. Obviously, that extreme volatility that we've experienced, that big sell-off and then rebound in the markets, something that we think about as becoming a bit more prevalent in terms of how markets are operating, and something that was really more back in 2022 that came up when we thought about the role of a 60-40 portfolio, how it really operated, and just the functioning of the public market. So on the left-hand side of the page here, you can see that the last bar is 2023. Things are looking quite good for that 60-40. It was a case of both equities and bonds doing well. But, we do have to look at that experience back in 2022 and sort of say, are we going to have that again? Is there going to be this experience where public markets don't really do what we expect them to? And are we going to have more bouts of this volatility and more times where the correlation between these assets doesn't really perform as we expect it to when we're constructing a portfolio? And it does seem like that when we think about that 60-40 portfolio, a lot of that sort of idea around it does predate the growth we've seen in the private markets and the accessibility that's come through in terms of how investors can position across them. And most importantly for us is really the fact that these correlations between stocks and bonds don't really stay negative. We have seen these regime shifts, as you can see on the right-hand side of this page, where the correlation becomes positive and persistently so for periods of time. So while we can see inflation coming down around the world, that stock-bond correlation perhaps heads back downwards towards something that's neutral, it is going to be a case of thinking around it being a little bit more volatile, periods where they do move in both directions together rather than zigging and zagging. And so we do have to think about how we can build in other ways to diversify a portfolio, or just more broadly thinking about the role that alternatives do play in that portfolio construction. Now, which portfolio you're looking at and which assets really fit into that from a public markets point of view is pretty clear. When it comes to the private market side of things, it's a little bit more of a hybrid case. We can obviously think about income-generating alternatives. We say take transport there, for example, that big bubble, really thinking about the income you get off that asset. It can be more around diversification and bringing down some of that volatility in the portfolio when it comes to things like real estate there. You can see that low correlation and also generating income. Or then on the far right of that side of that screen, we can think about these things that have a little bit more correlation with that 60-40 portfolio, but much outsized returns, and there we see private equity. But for us, I think it's not just about separating that into the income and growth. We are really thinking about private equity as how we add growth to that portfolio. Mainly because when we have these questions from clients come in, a lot of them do focus on the valuations in the public equity market and what we can expect from here. But also we don't think about private equity being something of a diversifier, but it can actually lower the volatility in your portfolio given the investment time horizons we're thinking about, and also just thinking about the mark-to-market process and the accounting volatility that can be attributed to it as well. So it does play a role in dampening some of the volatility in a portfolio, which may not be as expected as this chart may show you. But when it comes to thinking about the activity we've seen in the alternatives world so far, I really want to start with this. This is one of the first charts in our guide to alternatives. It just shows you the amount of dry powder out there. You can see the 2023 and 2024 bars at the end. That big purple chunk is private equity. There's not too much movement between 23 and 24. The 24 bar is only really capturing the first half of this year, though. But it really just suggests that there's still a large stock of dry powder out there in the private equity space being ready to be allocated. And that is something that we're always considering about how much money is out there chasing these deals, what that can actually mean to the market, how it's being invested. But I think when we turn to looking at what's the actual activity in the private equity market, Ushmi, if I can draw your attention to these two charts here. This really focused on the US. There are other pages in the guide to alts that look more global, but this one is looking at the investment side of things on the left-hand side and the exits on the right. If we start at the left in terms of investment, that 2024 bar is very low in terms of the investment activity we have seen in the private equity space. We still have all that dry powder that's sitting there that hasn't really changed since last year. So the question to you really is, what is the trends you're actually seeing across the fundraising in the private equity space? We don't see that stock of dry powder being drawn down. Is that going to be an issue in the long run? And where that money is being invested, what parts of the private equity space is it actually going into?
Yeah, great question. So first, I'll take it in multiple parts. The first is what is happening in terms of new deal activity. And you're absolutely right, and you can see it on the chart as well. Deal activity has slowed down significantly over the last couple of years, and similar what we're seeing year to date this year. And that's really driven by this bid-ask spread that exists between buyers and sellers, given the increased cost of capital with leverage, right? And so leverage obviously is important in terms of buyout investments in particular. We talk about LBOs, the L means leverage. And so the cost of that leverage obviously has gone up significantly over the past 2+ years. And that is driving new deal GPs that are looking at new deals to bring down their entry multiple, right? Because if the cost of capital has gone up, their entry price should probably go down in terms of, well, what do we need to pay in order to make our expected returns at the end of the day? And that is causing this bid-ask spread that has existed over the last couple of years. And it's more magnified. It was more magnified last year and has been magnified year to date this year. The other thing I think that's driving the lack of new deal activity is the fact that there's uncertainty around when rates are going to come down, as well as what the U.S. election and global elections, for that matter, are going to equate to, right? And so that's being played out in the real, in obviously real time. And I think once we move beyond these key elections in various different countries, that I think things will start to thaw even more. And if there is a rate cut in the U.S. and other places in the world, which have already seen a couple, I think that will drive new investment activity. All that being said, we've seen since July, so, in the second half of this year, now we're only a couple months into the second half, of course, but we are starting to see new deal activity at a higher pace than we saw in the first half. And that is driven by the fact that that GPs need to show distributions out of their portfolios, right? And so they are looking to sell perhaps at a price that is not as good as they were expecting a couple of years ago, for example, but they're open to more creative ways of exiting, whether it's through continuation vehicles with GP-leds or through other means of exit, right? And so they're being creative, even if it's a partial exit. And so that's driving more new deal activity and also driving some exit activity as well.
A couple of things there. I mean, partial exit is something that has been coming up more in terms of the conversations around the trend. Could you just really quickly explain that for the audience?
Yeah, so I'll take it in two parts. So the partial exits we're seeing in a couple of ways. The first is through GP-led continuation vehicles, which is basically a new type of vehicle whereby you can sell as a GP your existing portfolio company or portfolio company, so it can be single asset or multi-asset, to another vehicle whereby the existing investors in the original vehicle can roll into that new vehicle or sell, their shares. And there's new LPs that are signing up to that new vehicle. Importantly, the GP continues to be the same, right? They still are, in control of that portfolio company and are still executing the strategy that they were deploying now with a potential new set of LPs. And so the GP-led market is very, very active. This year, it represents about half of the secondary market, and it is forecasted to be about half of the market. So this year, we expect the secondary market to be about $130 to $140 billion in size. And half of that will be more traditional secondaries, LP fund interests that are being bought. And half the market is going to be these GP-led continuation vehicles. And again, it's a good opportunity potentially on the buy where we're deploying new capital into those GP-leds, but also importantly, it offers LPs an earlier point of exit that we didn't have before.
Yeah, we often think about these structures being relatively illiquid, but it's the GPs and the LPs wanting to create that liquidity, which is driving these kind of more creative structures you mentioned. But a list of things there in terms of the bid-ask spread, the leverage being used, the uncertainty, the geopolitical environment. There is some clarity around the rates outlook now. We do have central banks that are seeing a little bit more synchronized. Wouldn't go as far as saying coordinated, but at least synchronized in terms of that easing policy cycle, which should hopefully have a bit of an improvement. And again, you always have that geopolitical angle in the background sort of overshadowing a lot of things. On the exit side, you kind of covered off a lot of what we're seeing there and why we're not seeing that pickup in terms of the IPO market, obviously, given what we're seeing more broadly in terms of thinking around the use of leverage and other things. But I wanted to slip now and turn more and think about valuations. This is the other part of the conversation that we often have. There was the big reset in the valuations in the private equity public market, You did see it in the private equity space. If we look at the left-hand side of this page in terms of the debt multiples coming off, but the equity multiple didn't so much. But those bars in total are a little bit lower in 23 and 24 than they were in the prior years. Is that the best it's going to get in terms of the valuation being created in terms of the PE multiples coming off? Is it just going to be a bit more of a re-rating from here, or do you think that impact of leverage is going to continue to weigh on those blue bars and the debt side of things from here on out?
Yeah, the valuations, as you know, they've come down a little bit, broadly speaking, across the private equity market. But again, a lot of these are all kind of general overall market stats. But if you take a couple of layers down in terms of what's actually happening on the ground, what you're seeing is a flight to quality as well, right? Those companies that have strong cash flow generation, strong revenue growth, good margins, strong geographic positioning, as well as leaders in their respective sectors that are still private, they're getting higher valuations for all the reasons that we know. But there's also in the small and mid-market where we tend to focus, there continues to be opportunities where we are seeing less frothy valuations. And in the small and mid-market in particular, many of these companies where we're actively investing in and alongside our GPs, they are usually family-owned businesses oftentimes. And yes, price, of course, is very, very important to all sellers. But other factors are important to family-owned businesses as well. A lot of those families are rolling capital into those new deals. And so they care about who the new owner is. What is the future growth plan? What is their legacy going to be with this new owner? Is it someone they want to work with? And so, yes, of course, price is always important, but other factors play into it as well, which is why on average, and this is based on historical data, on average, the small and middle market has entry multiples about 20% lower than the broader market. Again, one of the reasons why we continue to focus on the small and middle market.
I definitely want to come on to that size bias and when you're focusing in the market. But before we move on the valuation side of things, you mentioned that bid-ask spread being a bit wider, and maybe that's why we're not seeing those valuations move. But, people coming together in terms of both buyers and sellers. Is it the case of reluctant buyers or reluctant sellers, or is it just both in terms of why it's still that quality of deals that are being done? And do you think that bid-ask spread would start to narrow if there isn't, I wouldn't say forced selling, but if GPs are looking to offload some of those things to create that liquidity and fund those distributions?
Yeah, you're absolutely right, Kerry. So we already are seeing some I guess breaking of that logjam on the seller on the bid-ask spread, and it's really driven by what you're saying. So we are seeing one of the lowest years in the last 15 years in terms of distributions back to LPs. And that is driving, of course, GPs to say, well, we might need to create liquidity for our LPs soon because we need to raise our next fund. And so we want those LPs coming back. And so they are being more creative, as I said, on GP-leds and on other types of exit strategies. And to your point, perhaps okay with going a little bit lower in terms of what their exit price, was originally. And part of it's also around the uncertainty of the market itself. And so it's not like the same buyers may still be around in a couple of years or whatever it may be. So we are seeing a little bit of a breaking of that log jam over the last couple of months.
It does feel like the things are becoming a little bit more, I don't know, normalized is the right word, but, a lot of those barriers to what's actually been holding up the market are definitely starting to ease over late. And I think when we get our new edition of the Guide to Alternatives, you'll see some of these changes coming through in the data as we update the last quarterly numbers to come through. On terms of this part of the market you operated in there, you mentioned that you have that preference for the small mid-market. I think this really shines through when we look at this in terms of the deals being done, in terms of the activity. And you can see that this bar just shows you the grey is the range of the deals. Obviously, the purple bar through the middle is the sort of median, and then the blue diamond is the current when we look at these numbers. And if you look at, say, the LBO or the buyout side of things, the diamond is right at the bottom of the bar. Things are being impacted by that leverage and the cost of that capital, as you mentioned. And then on the size bias, it does seem things are on the smaller side in terms of that less than 25 million or 25 to 100 million, we are seeing more activity. A common thing, and I'm sitting here in Australia, is that when we talk about market size and market cap, when we talk about small and mid, that can make it a very different thing for someone in Australia than it can mean for someone in, say, the US. So when you think about small and mid, can you just define what that means for you as an investor, and also whether that's an industry standard or whether different investors would have a different view of what small and mid cap actually is?
Yeah, that's a great point as well, because you're absolutely right. There are different ways that every investor defines what is small and mid-market, and that definition can change over time as well. Our definition has been pretty much the same since inception over 40 years ago, which is we're looking to invest in funds that are under $3 billion in fund size, and in co-investments in companies that are under 1.5 billion in enterprise value. And it actually ends up being that most of our co-investments are in companies under even 500 million in enterprise value. Just because they're small doesn't mean they're not leaders. These are leaders and very profitable businesses with strong margins and growth potential, respective in their sectors. But you're absolutely right. I mean, the way that other clients, investors, peers define it has changed over a long period of time. And we focus on this end of the market because we continue to believe that this is the most, it has the most attractive potential to get sustained alpha generation over a long period of time, because it is the most inefficient part of the market.
Very good. Actually answered one of the questions that have come through then about why the small mid cap generates outsized returns. I guess it's that availability of information, the ability to do better due diligence than your competitors, and thinking about the ability to take advantage of that inefficient market. You also mentioned co-investments there. There was another question that's come through around the advantage of doing a co-investment. If we're thinking about private equity relative to a different structure, whether it's simply just investing in it, is there a reason why you're looking at co-investments as well?
Yeah, so we've been doing co-investments for a very, very long time, since the 1980s, and we continue to feel that the market is very attractive for co-investments, at the current time and into the future. And why are co-investments additive to a private equity investment program? There's a number of reasons. Number one, first of all, let's just say, what is a co-investment? A co-investment is an equity investment that we make that is done alongside of a GP buyout sponsor. So they're controlling it, but they need equity to consummate that transaction. There has a number of reasons why it can be attractive. Number one is you're able to get in usually into co-investments on a attractive fee basis. Oftentimes they have no fees associated with them. And so that can be attractive. The second reason is you're able to curate a more concentrated portfolio with direct investments in areas of, in sectors of the economy where you want to increase exposure, right? And so they're more concentrated positions in a curated manner on a no fee, often on a no fee basis. The other thing that what can be attractive about co-investments is that they usually have a shorter duration as well, right? Versus investing in a primary fund that has a 10 to 15-year term or life. A co-investment, usually you invest all the capital right away, day one, there's no J-curve, and then you can expect to get distributions back when that company is sold or exited over a 4 to 5 year hold. And so there's usually a shorter duration with them as well. Now, there are some reasons why, obviously, there are risks around co-investments as well, and that's why diligence is very, very important, because these are concentrated positions within direct companies. And so understanding all the factors around financial performance, the management team, the sector, the total addressable market, what the financial growth can be, what potential add-on activity for add-on acquisitions, which was on one of your prior slides, what add-on acquisitions and activity can we do to increase EBITDA, not just organically, but also inorganically? And then ultimately, obviously, what is the entry price? How much leverage are we putting on those investments? But what do we expect the multiple on exit to be as well? So because they're concentrated positions done alongside a GP, there's a lot of diligence needed around what type of investment you're doing and when and who with, right? And so obviously we've been doing it for a long time, but those are critical factors in actually implementing a successful co-investment program.
Oh, it's fantastic. There's actually a couple other questions that come through on the co-investment side of things too. So hopefully that's answered those for our listeners as well. One bit that didn't quite get to touch on there was around where you position between primary, secondary, and co-investment in different parts of the market cycle. Is there a stage in the market cycle where you go primary, where you go secondary, where you go in co-investment, or is that less important when you're thinking about how you're structuring your funds?
Yeah, so we try to have a pretty flexible investment commitment, every single year, and that's based on where we see the most risk-adjusted, attractive returns across our very, very large market. And so for now, we see the dislocations based on the lack of exits that we talked about. There's a dislocation that's driving increased deal flow and attractive, high-quality deal flow in the secondary market. And we talked about the GP-leds already and where we've been active there and how that market has grown to be able to tap into, some, in many cases, strong businesses that need additional capital to execute, continue to execute on their strategic plans. But also, there are LPs that are looking to sell high-quality buyout and venture capital funds in the secondary market because they're looking to get liquidity. They're not liquidity constrained or cash constrained in any way, but they're looking to tap into that secondary market to be able to get liquidity to make their further capital calls that they need to make or further commitments into private equity and venture. And so I talked about what we expect the market to be this year, $130 to $140 billion. That's, a peak for the secondary market. And importantly, we are looking at small and mid-market funds. Again, you'll hear that often from me. Small and mid-market focused buyout funds where we can buy attractive, high-quality positions for attractive discounts. And by that, I mean about 5 to 20% discount relative to the net asset value of those funds. So we see a strong opportunity set right now, given that distribution dislocation that exists. And co-investments, talked a lot about that already, but we see that dislocation exists with co-investments right now as well because the fundraising market has been quite slow. On average, a new private equity fund is taking 18 to 24 months to get that new fund raised. During the peak of 2020, 2021, it could be as low as 6 months. We've gone back to the long-term averages of 18 to 24 months, and GPs have to be more creative and willing to work with LPs, particularly large strategic LPs, to co-invest and offer them more creative situations to entice them to potentially do their next primary fund, which is taking longer.
I mean, kind of answering all the questions I had before we got there, Ashmi. The thing I wanted to talk about next was actually that the secondary market there, and you've kind of touched on a lot of what's in the slide already, and given us better information than we're showing here. So obviously being in the markets every day helps relative to what the data we get on a lagged basis is from many of our providers. But On the left-hand side there, you have secondary market volume. As you mentioned, you're expecting it to be more like 130, 140 billion for this year compared to the sort of 112 we saw for last year. Those discounts that we're seeing across the NAV there, anything from sort of 9% on the buyout side all the way down to something more like 32% for the venture. You're saying they're more like 5 or 10% now. So pricing does seem to have shifted a little bit there, but still that discount coming through. And you also talked about the valuations on that secondary market, the lower leverage coming through. I wonder if you could speak a little bit more on the exit side when it comes to the secondary market. So if you're getting in terms of a growing market because there's that need for liquidity, that need for GPs to form those distributions, how are you getting out when you've gone into these deals in terms of thinking about an exit strategy?
Yeah, so we're buying on the secondary side when we're buying LP secondaries, which means we are buying an existing interest in a fund, usually a buyout fund, a small mid-market buyout fund, from another existing LP. And we're very active in that market based on the dislocation I talked about earlier. And the reason why is because we're buying more mature interests, right? More mature vintage years. So on average, 2017, 2018, 2019 vintages, which are 5, 6, 7 years into their term already, which means they already have a portfolio that we can diligence. And to your question on exits, there is the potential to exit sooner, right? These are more mature funds. Their companies are already, 2, 3, 4 years into their life. And so we should start to see some harvesting out of those portfolios in the near term. And that can be attractive from an IRR perspective, of course, but also potentially from multiple perspective based on where we are coming in at those discounts. Where we're focused is on the higher quality opportunities, and there's a lot of deal flow in the current environment.
And then just on that, you talked about both GP and LP-led secondaries. I mean, are there pros and cons between each type, or are there certain risks you're more mindful of, whether it's a GP versus an LP, led deal that you're really thinking about, or that investors should be aware of?
Yeah. So on the GP-led side, there are a few factors that I think we need to continue to keep in mind. Right. There's a potential for conflict because the GP has the existing position already. They're looking to sell it to a new set of LPs. They're looking to crystallize their carry. Are they rolling all of their performance fees into the new vehicle? So we've gotten a little bit more, as an industry, more mature around GP-leds, where some of those conflicts are mitigated through the actual structures and through the terms. And LPs can, look to negotiate those terms as well. And so the GP-leds can be attractive. If you're looking to get into a deal where the GP obviously is already implementing their strategic plan and their strategic vision, and you have the ability to look at the valuation, set the terms. They usually have fees on them, which is another thing to keep in mind versus co-investments, which usually don't. But there's an ability, at least in this market, to take your time on diligence and to potentially negotiate fees lower on some of those GP-leds, which can be attractive. Of course, those are more concentrated positions, like co-investments, and so you have to be very careful about at the end of the day, what company are you buying into, because they're more concentrated direct company positions. On the LP side, I think there is a lot of work that has to be done around what type of portfolio you're buying into. What is the valuation policy of the GP? Are they more conservative on how they're valuing businesses? Are they more aggressive on valuing businesses? And that's where obviously our work is very important to evaluate that and to determine, okay, what is the right price we want to pay for that set of portfolio companies within that fund or within that set of funds, and what is an appropriate exit timing and valuations, and what exit multiple environment are we going to be in when those exits do happen. The other thing I think that can be, a little bit cautionary in the LP side of the market is people can get attracted to things that are heavily discounted. You saw that on the venture side, 68% of NAV is what the average discount is for venture capital secondaries. Well, I mean, that sounds good, but just because something is at a low price doesn't mean it's high quality, right? And doesn't mean there's maybe appreciation that is going to come from that investment over time. And that's also something that we spend a lot of time on in terms of what is actually in that portfolio, what would the entry multiples pay for those companies, how much leverage is on that portfolio and within those companies, and what is a realistic time frame of growth within those portfolios, and then time frame of exit. And so those are the key things you have to keep in mind when you're buying LP secondaries.
Thanks for the very, very comprehensive answer. And it's a similar thing that we talk about in the public markets. Obviously small cap stocks became very cheap. People were very attracted to thinking about the upside potential, but you've always got to have that mindful focus on the quality of the asset you're actually buying and what you're actually getting and why that discount is being applied. Another question that's come in here, it's a very short, sharp question, but I think it's probably worth asking. It's simply saying, is small safe? I mean, if we compare what may be happening to the large caps or the larger side of the market for private equity, you talked about the inefficient process and the smaller side that creates these value opportunities, but is there additional risk that comes with that compared to, say, what's happening in the larger end of the market?
Yeah, there is this perception of, the smaller companies or small and mid-market companies are inherently more risky because they're smaller. I would define risk a few different ways. So on the small end of the market, these companies are usually less levered. So on average, 20% less leverage on these companies relative to the larger end. That can be actually less risky to a business, right? Where you have less debt service that you are having to put on these businesses should they hit a bump in the road. Inevitably, a lot of companies do. And so I think that actually has less risk associated with it. There is potential, like we are focused on companies that are small, but they are profitable, a multiple, 20, 30, 40 million plus of EBITDA, strong leaders in their respective sectors with strong financial growth going forward, and importantly, less leverage on those companies should they hit a bump in the road. And so I would argue, yes, there's wide dispersion across our entire asset class, right? From bottom quartile to top quartile, there's a 20% difference. And so, but within the small end versus large end, there's different ways that we analyze risk. Leverage is one. Obviously, are they market leaders is another. And so those are the key factors where we continue to remain focused on the small and middle market. And I would argue they have different types of risk versus just an increased risk.
Yeah, absolutely. And that point around leverage, again, coming back to that, thinking about the rate cutting cycle, interest rates coming down. I mean, there's still a big question about how far they will come down, given the growth outlook is still pretty good around the world. And, it's not going to be like the prior days where leverage is going to be super cheap and the cost of capital is going to come down fully. So I think there's probably still a little ways to go on that debate around the leverage and how it may be used in the future. A couple other questions that have come in here that really go more to the structure of the funds that we're seeing come to the market, and again, some of what we hear from other people active in the PE space. The first is there around the range of open-ended or these semi-liquid structures for private equity funds. I mean, do you have a view, given that obviously we have underlying assets that are relatively illiquid, about how these semi-liquid funds can be structured? And the other one we hear a lot about is obviously the rise of these evergreen funds. I mean, do you have a view around where the industry may be going in terms of this liquidity profile or closed versus evergreen structures?
Yeah, so on the evergreen funds, certainly we've seen the rise of evergreen funds over the last several years. And I think they play an important role in the market, meaning they provide an additional access point to a potentially wider set of investors. I don't like to use the term semi-liquid because, yes, they do have some liquidity provisions within those vehicles, but these are not liquid funds, to your point, because this is still an illiquid asset class. And these are not ETFs or liquid funds at all. And so, but what they do offer, to your point, is the flexibility on a number of different factors. Number one is the ability to have a wider set of investors invest, because there's lower investment amounts that you can make. There's also no capital calls. So there's some parts of the private equity market and parts of the investor set that doesn't want to deal with those capital calls, doesn't want to reserve cash. They can invest right away into a private equity vehicle, and then they're fully invested day one into whatever that vehicle is invested in. So there's no J curve as well. The other thing is, to your point, there is the potential to have liquidity. Usually it's up to a certain percentage of the fund's NAV on a quarterly basis. Usually it's subject to board approval. But as we all know, life happens. Liquidity sometimes is needed for whatever reason. And this offers the ability, these types of vehicles offer the ability to tap into that liquidity. And so I think for a lot of those reasons, you're going to continue to see growth in the evergreen market. It solves issues for various types of investors and potentially, has liquidity associated with it. We believe there's certain parts of the market, secondaries, co-investments in particular, that have shorter duration, that should have, earlier exits within those types of businesses, within those types of companies, which could work well within an evergreen structure.
Yeah, it certainly is a case of reading the fine print when you hear about some of these products, what illiquidity actually means when they're talking about it, with where it may be gated, where you might see the percentage of drawdowns be capped, or for example. But I do feel it's going to be a step in the right direction, because we talk a lot about wanting to build out more alternatives into a portfolio, and obviously that access is so crucial to that. So it is somewhat encouraging in terms of these shifts we are seeing. But again, buyer beware by all means when it comes to reading that fine print around what semi-liquid actually means. Another question, and apologies for just peppering you with all these different questions that have come in. This one is around about NAV financing. So thinking about your view on this, is this actually a positive, or is it beneficial for the industry, or do you think it's going to just create more risk down the road?
Yeah, that's a great question, and we're certainly seeing a lot more NAV lending facilities that are active in the market or looking to find companies to invest in, and NAV lending funds, for example. We do not invest in those funds. I am, sounds like the investor on the phone is maybe like-minded. I'm a little leery of that market, because unless it's absolutely needed, where there's companies that actually need capital because of some bump in the road that they have, or they want to execute on the add-on strategy. Aside from that, I think it can be very onerous to the GPs, to the underlying companies, because it's not cheap, as well as to the ultimate LPs in those funds, because what is the collateral that's being used for that NAV lending facility ultimately? And so it is quite complicated. We don't see it a lot in our portfolio, thankfully, but it's certainly a flavor of the day.
And finally, there's one other sort of area I wanted to ask you about. You kind of talked about a little bit when it comes to the VC side of things. I think this is probably an area that you've been looking at in the past, or may have more interest in. We saw those big discounts on the prior slide around this. Is there opportunity in the VC space? Is it purely around AI and tech, and who's going to be the next big winner, or are there other opportunities or not when it comes to looking at VC at the moment for you?
Yeah, so we're excited about venture capital as well, and we've invested in venture capital since 1980. So what hasn't changed about venture capital is the technology disruption, right? Innovation continues at a pace that we have not seen in a long, long period of time. And that hasn't changed, and that's not going to change in our opinion. And AI is just another example of that. AI is a massive platform shift. It is real. We all know it. We all use some type of AI in our lives, probably on a daily basis now, whether it's as a consumer or as an enterprise. So we are very bullish on technology disruption innovation continuing, particularly with this platform shift that has happened. What is also happening, however, in venture capital is that the entry valuations for AI investments, and there's been a lot of media reported on this as well, is frothy. So every company says that they're an AI company, and they're looking for the highest pre-money valuation. And so I think that is going to be tempered. There's probably going to be some sort of correction, right? Not all those companies are going to make it. Not all those companies, by the way, are AI. Not all of those companies, or many of those companies, don't even have a profitable business model. And so a lot more has to be seen in how this platform shift actually results in profits in these companies. But so where we're focused is on the earliest stage of venture capital, where we believe we're getting in at the most attractive valuations on a risk-return basis, because innovation is not dead. It's in fact increasing. And because the best entrepreneurs are continuing to want to start new businesses, particularly with this new platform shift. And so our focus is on early stage funds and companies in small, again, you're going to hear me say small a lot, in small size funds, under $1 billion in size, under $250 million in size in terms of VC funds. And we actually added this year already some interesting new venture capital funds, again, on the early stage and small side.
I mean, and it goes without saying, I think anyone who's been interested in the private equity space will know the story, but, most of the value that's been created in these companies is before they go public, and they're staying private longer is the biggest trend we've seen over time that, and you want to be part of that wealth creation at those early stages. So going into those very early stage VCs just gives you the most upside potential when you do identify those ones that are going to be more beneficial or can tap into these very long run secular themes that we see playing out. Again, Ashmi, thank you again for taking the time out of your very busy schedule as you travel around Australia to spend time walking us through your current views on the PE landscape and focusing particularly around the secondary market. And just a reminder, small and mid is where Ashmi is really focused on the opportunities at the moment to come through. Any questions that didn't come up that you may have, always reach out to your JP Morgan client advisor. Happy to chat at any time around anything we did or didn't cover today or any other topics that may be on your mind. But just once again, Ashmi, thank you again very much for your time today and very appreciate your insights in terms of the world of private equity.
Well, thank you, Kerry. Really appreciate the opportunity.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.